assets, liabilities, equity, revenue, expenses. 5 types of accounts in accounting you must know. So let's get right into it. Hello everyone, it's Vic the CPA. Welcome to my channel, Accounting Masters. There are 5 types of accounts in accounting you must know. We'll be going through what a balance sheet and income statement is in the next video, but first we must fully master these types of accounts as they will appear in the balance sheet and income statement. Basically, all accounting transactions you will encounter in the future will be classified into these 5 types of accounting accounts. Oh, by the way, when I say the word company in the future examples, it means limited company, as that is the type of company that people mostly use. So the first 3 types belong to the balance sheet. The first type of account, we always hear the term assets. So what are assets? Assets are what the company owns or controls. Examples: cash and cash equivalents, which means cash, petty cash, or cash at the bank, or bank deposits. Inventory, goods for resale if you're a retailer, and goods manufactured if you're a manufacturer. Accounts receivables, which are goods sold to customers paid on credit, which they would pay on a later date, or money owed by the company's debtors that the company has not gotten back, are all listed under accounts receivables. Rental security deposit. When a company rents office space, the landlord will usually want a rental security deposit of 1 to 2 months of the monthly rental. This security deposit provides the landlord with the assurance that if the company defaults on rent or damages the property, the landlord can use the money to recoup the lost rental income or fix the damage. This rental security deposit will be returned to the company when the rental term ends. Therefore, the company owns this, so it is considered as a current asset. Fixed assets: land, buildings, motor vehicles, machinery, office equipment, and computers. Company owns, and fixed assets help produce income for the company for a longer period. So the second type of account is liabilities. What are liabilities? Liabilities are the opposite of assets. It is what the company owes to someone else. Account payables, amounts owed to creditors. Goods purchased from the company's suppliers to be paid on a later date. Other payables, amounts due to its directors or amounts due to third parties. Accruals, costs that have incurred during the period but the company has not paid yet. So for example, the electricity bill of $100 incurred for December 2022 has been recorded under electricity expenses, but up to February 2023, it has not been paid. Since the company still owes $100 to the electric company, it is considered as a liability. Bank loans. Money borrowed from the bank is a liability as the company needs to repay the bank. So the final type of account on the balance sheet is called capital or equity account. This is the company's owner's account, and it is what the company owes to the owners or shareholders. So one of the equity account is called share capital, which is the amount owned by shareholders. The shareholders put capital into the business for it to run in exchange for shares of the company. So each shareholder will own part of the company depending on how much they put in. For example, if there were 10,000 shares worth $1 each and shareholder A purchased 6,000 shares, meaning that shareholder A owns 60% of the company. Shareholders will not be personally liable for any losses the company incurs, and their liability is limited to the nominal value of the shares they own. Drawings is also an equity account. It shows how much money the owner withdrew from the company. Retained earnings or accumulated loss. So under the equity section of the balance sheet, this account shows how much the company has made or lost since the beginning of incorporation. You will notice that this account is the accumulation of all the previous year's net profit or loss. Current year's earnings or loss. This account is the current year's net profit or loss amount from the income statement. This amount was closed off from the income statement and transferred to this account. More on that later when we explain about the income statement. Now we know these types of balance sheet accounts, you will need to memorize this accounting equation. It is very, very important. So it is assets, what the company owns, equals liabilities, what the company owes to third parties, plus equity, what the company owes to its owners. Or it can be rearranged to assets minus liabilities equals equity. Either way, both sides of the equation will always balance. Every transaction that the company make or enter always have two aspects and double effect on the accounting equation. This is called the duality concept. Most shareholders or business owners would like assets minus liabilities equals equity, as it would mean that there are more assets than liabilities. This is called net assets. We now focus on the last two types of account, which belongs to the income statement. So one type of account that belongs to the income statement is called revenue or income. Basically, this is how much money the company earned during that time period by selling their goods, which is called trading income, or services called service income. So if the company is an online trading business, their income will be from the products that they sell. If the company is a gym business, their revenue will be from personal training sessions or group classes taught by the gym trainers during that period. If the company is a rental company, their income will be rental income earned during that period. So the final type of account that belongs to the income statement are expenses. Expenses are the costs of operations that the company incurs to generate the revenue. For example, for an online trading business, the cost of goods sold is the expense for the selling the product into becoming the sales and income. Rental expenses, the cost of renting the space for the business. Salaries expenses, the company pays the staff for their work, and the staff's work generate income for the company. Commissions expenses, for the sales team for generating sales for the company. You will see that each cost will contribute in generating revenue for the company. So the income statement equation is basically revenue or income minus expenses equals net profit or loss. So if the income is more than expenses, then it would be net profit. And if expenses are more than income, it would be a loss. An important note is that revenue and expenses account make up the income statement. As mentioned before, they must follow the matching principle, also known as the accruals concept, meaning that income and expenses are recorded in the income statement as they are earned and incurred, regardless whether it was paid by cash or paid by credit. And there you have it, the 5 types of accounts in accounting you need to know. If you like this video, please click on the like button and comment below. And please show your support by pressing the subscribe button and notification bell so you won't miss out any new videos in this channel when they come out. Thank you, and I'll see you in the next video.